Good morning. What's going on? Want to do a quick video to deep dive as best as we can in a quick video with manufactured homes. This comes up all the time. So I just figured I'd get a video out, put it on. It'll put it on YouTube and Facebook and probably a couple other places. But manufactured homes, there's a lot of confusion. So we're going to start with what is real property, what is not real property. And when you talk about a manufactured home and the type of loan that's associated to it, there's two factors. Well, a few factors, three factors. So first one, is the manufactured home on land that's owned? And then is it permanently affixed? So is it land that you own with a home that you own that's permanently affixed to it with a permanent foundation? If it is, USDA, FHA, conventional, VA. You can use all of those programs unless it's pre-1976. So it has to be 1976 or newer. 1976 or newer. If it's 1976, you own the land, you own the home, and it's permanently affixed with a permanent foundation, you can use USDA, VA, FHA, and conventional loans in order to purchase that property. You could also do just about every type of renovation program as well. So whether it's a 203K on the FHA, renovation through the VA, renovation through conventional, which is like a HUD product. But then it's good. Now, when do you own the land and it becomes weird? Well, if any one of those factors are different, right? So factors are different. It's not permanently affixed, not a permanent foundation. Then it becomes a chattel loan. You don't own the land, then it's a chattel loan. It's pre-1976, then it becomes a chattel loan. So what is a chattel loan? A chattel loan is for anything that is movable, right? So even though it's a manufactured home, mobile homes. So mobile homes are 1976, pre-1976. So 1975 or older are considered mobile homes. Manufactured homes 1976 or newer. So a chattel loan is a specific type of a loan product for when we look at it in this context, manufactured homes. It is not, if it's not real property, it becomes a chattel loan, chattel loan. So what are the adjustments on that? Okay, well, big difference. So we already know when it comes to FHA, everybody knows a lot about FHA, VA, conventional, and some USDA, right? But almost nobody knows about chattel. So what's a chattel loan product? Well, it's going to be different. Typically, people will call me because they want a chattel loan because it's on leased land, a manufactured home on leased land. But there's a ton of different variations. I've already told you which ones, right? Where it falls into a chattel product. Chattel loans, 5% down. Credit score 550 plus, 550 plus credit score. And the big one that people really struggle to swallow is the interest rate. Interest rate is typically going to be 1 to 2 percentage points over the going rate. So if the going rate right now is 5, it could be 6 or 7. If the going rate is 6, it could be 7 or 8. Now, I've seen other companies that will charge quite a bit more than that. But I know for me, it's typically 1 to 2 percentage points over the going rate as a chattel loan. Well, why is that? That seems messed up. Well, okay, maybe. But think about it like this. Is it more risk to the bank? That's really what interest rates are. It's a matter of mitigating risk and also making a profit for lending money. Because I always try to tell people there's only two things a bank cares about: protecting its asset and making a profit, right? So if you have a very good asset, and let's say you default on a loan. If you own an asset, it's a house that's in a normal neighborhood where there's no inventory issues. They know they put the house on the market, it's going to sell, they're going to get their money back plus whatever is due. A bank will give you a lower interest rate on that. If you are more credit worthy because you borrow money and you pay it back on time and you have good credit, well, then your interest rate comes down. But whenever there's more risk involved, the bank asks for a higher interest rate. When you talk about a home that is not on owned land, or it's not on permanent foundation, or, right, the factors that we had mentioned, well, that's more risk. Therefore, more interest, more risk, more interest. It correlates. It's pretty straightforward. So the interest rates typically be 1 to 2 percentage points over the going rate. Now, considering where the rates are right now, it's still not bad, especially when you look at the cost of manufactured homes that are on a chattel loan are almost always going to be way cheaper than if you bought a home, a manufactured home, that is not on a chattel loan. So, I think you got to take that into consideration. If you have a manufactured home that's 1976 or newer, on owned land, on permanent foundation, it's worth more on land. But if it's not on owned land, it's typically significantly cheaper. I saw one the other day, somebody hit me up that said, it's actually right here. $380,000. It's on an acre's worth of land. And as soon as he said that, and it's in Southern California, I go, okay, what year was it built? Oh, well, it was built in like 1974. Well, there's the reason. The reality is you can't get a normal loan. Otherwise, that manufactured home, as big as it is on an acre's worth of land, should be in the 500s. So it is a significant difference. But if you're paying less because it's a chattel type loan product, well, guess what? The interest is going to be a little bit higher, so it kind of offsets. This is what usually kills a lot of people. It's not the interest rate that kills people. It's the land lease. Land leases, I've seen them go anywhere from $400 up to $3,000. A lot of the manufactured homes that are out on the coast, they're running about $3,000 a month for a land lease. Now, I know that sounds crazy, but in order to live on the beach, that's the key. Do you want to live on the beach? You do. You want to live on the beach in Orange County? You do. Can you afford a multi-million-dollar house? You can. But can you afford a $600,000 manufactured? You can. Can you cover the land lease? Yes. Is it still cheaper than buying a multi-million-dollar house? Absolutely. So that's why a lot of people love manufactured homes. So yeah, I just want to kind of break that down. 5% down. Typically, the closing costs can be rolled into the loan, or you can pick and choose what you want to roll into the loan or pay out of pocket when it comes to closing costs. And interest rate is typically going to be 1 to 2 percentage points over the going rate, right? And 550 credit score or better, and then know the difference on what it is. So anything that is not on permanent foundation, or and there's, like I said, there's the variables. So 1976 or newer, 1976 or older, depending on which one, right? Is it on permanent foundation? Is it not on permanent foundation? Is it on loan land, or, owned land, or is it not on owned land? Will dictate if it's a chattel or not a chattel. So I figured I would just do this video real quick because I talk about this all the time because I do a ton of manufactured home loans. I put it up and then I can start sharing it whenever people have this question. I can sort of share the video. So thank you all very much. Appreciate it. And I'll talk to you later.